the end of this video, you'll understand exactly why Japan's biggest beverage companies are abandoning their comfort zones to enter healthcare. You'll see the demographic forces driving this shift, learn which companies are positioned to win, and discover how this trend could reshape your portfolio decisions in Asian consumer markets. If you want to understand why Japanese corporations make the moves they do, and what those moves signal for global markets, subscribe to stay ahead of the curve. Good morning, everyone. I'm Polaris AI, and today, we're witnessing a transformation that most people completely miss. Japan's beverage giants are quietly becoming healthcare companies. 240 billion yen. That's $1.6 billion. The price Suntory just paid for something most people would never associate with a beer company. They bought a pharmaceutical subsidiary. And this isn't some small side bet. This is Suntory, one of Japan's most iconic beverage companies, making a massive strategic pivot that signals where Japanese business is heading. Picture a typical Japanese consumer. Maybe someone in their 50s, standing in a convenience store after work, not reaching for a beer, but instead scanning the shelves for supplements, painkillers, wellness drinks. This scene is playing out millions of times a day across Japan. And Suntory noticed. The company just announced it will acquire Daiichi Sankyo Healthcare, the subsidiary of pharmaceutical giant Daiichi Sankyo that manufactures over-the-counter painkillers, cold medicine, and health products you'd find in any Japanese drugstore. This is the maker of Loxonin, one of Japan's best-selling pain relievers. Here's what you'll understand by the end of this video. First, why beer companies are suddenly desperate to buy pharmaceutical assets. Second, what demographic time bomb is forcing this strategic shift. And third, how this single acquisition reveals a playbook other Japanese giants are already following. This channel exists to help you see these patterns, because understanding cause and effect in Japanese business changes how you evaluate every corporate move coming out of Tokyo. Here's the problem Suntory faces, and it's not subtle. Japanese people are drinking less beer. A lot less. Since the peak consumption years in the mid-1990s, beer sales in Japan have dropped by roughly 25%. And it's not just beer. Overall alcohol consumption has been declining steadily for over 2 decades. This isn't a temporary blip. This is a structural collapse of the core business model that built these beverage empires. Think about what that means for a company like Suntory. They've spent over a century perfecting the art of brewing and distributing alcoholic beverages. Their entire infrastructure, the factories, the distribution networks, the brand relationships with retailers, all of it was built around the assumption that Japanese people would keep drinking. But demographics don't lie. Japan's population is aging rapidly. Younger generations drink less than their parents did. Health consciousness has gone mainstream. The government has even launched campaigns warning about the health risks of alcohol consumption. So your Suntory's leadership team, looking at these trend lines. Your flagship products are in secular decline. The market isn't coming back. What do? You can't just optimize your way out of this. Cost-cutting won't create growth. You need to find new revenue streams, fast. And not just any revenue streams. You need businesses that actually benefit from the same demographic trends that are killing your beer sales. This is the strategic bind that forced Suntory's hand. But here's what most coverage of this acquisition misses entirely. This isn't just about declining beer sales. The root cause goes much deeper, and it's reshaping every consumer-facing industry in Japan simultaneously. Japan is the world's oldest major economy. Over 29% of the population is now 65 or older. By 2040, that number will exceed 35%. We're not talking about gradual aging. We're talking about a society transforming in real time. Right now, faster than most corporate strategies can adapt. And here's the counterintuitive insight. This demographic shift doesn't just destroy certain businesses. It creates massive new markets. Think about what an aging population needs. Not more beer. Not more sugary soft drinks. They need pain relief. They need supplements. They need preventive healthcare products. They need anything that promises to extend healthy, active years. The over-the-counter pharmaceutical market in Japan is projected to grow significantly over the coming decade. Self-medication is becoming culturally normalized. Older consumers are proactively buying health products without doctor visits. Meanwhile, the beverage market? Flat at best, declining in most segments. So the real cause of this acquisition isn't that Suntory's beer business is struggling. It's that Japan's demographic reality is creating a massive wealth transfer from alcohol and entertainment spending toward healthcare and wellness spending. Suntory isn't just buying a pharmaceutical company. They're repositioning themselves on the right side of this wealth transfer. And once you see this pattern, you'll start noticing it everywhere in Japanese corporate strategy. And here's where it gets really interesting. Suntory isn't acting alone. This pattern is playing out across every major Japanese beverage company simultaneously. Look at Asahi Group Holdings. They've been aggressively investing in health and wellness categories. Their functional beverages and supplement lines have become increasingly central to their growth strategy. Kirin Holdings might be the most explicit example. They've pivoted so hard toward healthcare that they now describe themselves as a health science company rather than just a beverage maker. They acquired pharmaceutical assets, invested in biotech, and restructured their entire corporate identity around wellness. Even Sapporo has been diversifying into food service and real estate to reduce dependence on beer sales. This isn't coincidence. This is an entire industry recognizing the same demographic reality and racing toward the same solution. The beverage giants have several advantages in this pivot. They already have massive retail distribution networks. They understand consumer marketing. They have strong brand recognition and trust. And they have cash, lots of cash from decades of profitable beer sales. What they lack is pharmaceutical expertise, regulatory relationships, and established healthcare product lines. That's exactly what Suntory just bought with this acquisition. Daiichi Sankyo Healthcare brings established brands, manufacturing capabilities, regulatory approvals, and a sales force that knows the pharmacy channel. This is why the price tag makes sense. 240 billion yen isn't just buying a company. It's buying a decade's worth of capability building that Suntory could never replicate on its own. But here's the perspective shift that changes everything about how you evaluate this deal. Most analysts are looking at this acquisition through a traditional M&A lens. They're asking, did Suntory pay a fair price? Will the synergies materialize? Can they integrate the operations smoothly? These are fine questions, but they miss the bigger picture entirely. The real insight is this. Suntory isn't just buying a business. They're buying relevance in Japan's future economy. Think about what Japan will look like in 2040. A third of the population will be over 65. Healthcare spending will dominate consumer budgets. The companies that matter will be the ones providing health, wellness, and longevity solutions. Now ask yourself, which company is better positioned for that future? A pure-play beverage company with declining alcohol sales, or a diversified health and wellness conglomerate with both beverage and pharmaceutical capabilities? This acquisition isn't about next quarter's earnings. It's about whether Suntory will still be a relevant company in 20 years. And viewed through that lens, the price becomes almost secondary. What you're really paying for is a seat at the table in Japan's aging society economy. This is the turning point in how sophisticated investors should evaluate Japanese corporate strategy. Stop asking whether the deal math works today. Start asking whether the strategic positioning makes the company essential tomorrow. Suntory's leadership clearly understands this. The question is whether the market does. So what actually changes once this deal closes? Let's get concrete about the action shift happening inside Suntory. First, distribution integration. Suntory already reaches virtually every convenience store, supermarket, and vending machine in Japan. Daiichi Sankyo Healthcare has relationships with pharmacies and drugstores that Suntory doesn't currently serve as effectively. Combining these networks creates one of the most comprehensive consumer product distribution systems in Japan, spanning from beer to painkillers, from soft drinks to supplements. That's over 30,000 retail touchpoints with expanded product categories at each one. Second, cross-selling opportunities. Suntory's existing health drinks and functional beverages can be marketed alongside pharmaceutical products. Imagine integrated wellness solutions, a Suntory vitamin drink paired with a Daiichi Sankyo supplement, promoted together as a daily health regimen. This kind of bundling is only possible with own brands across both categories. Third, research and development convergence. Pharmaceutical R&D capabilities can inform functional beverage development. Understanding how active ingredients work in pills can help create more effective drinks. The scientific expertise flows both directions. Fourth, brand portfolio balancing. When alcohol sales are weak, healthcare products may be strong. When people feel healthy, they might drink more socially. The combined portfolio creates natural hedges against single-category volatility. None of this happens automatically. Integration is always harder than the press release suggests. But the strategic logic for each of these action shifts is sound. Suntory isn't just adding a business unit. They're fundamentally rewiring how they create value for Japanese consumers. Let's fast forward and examine the outcomes Suntory is building toward. If this integration succeeds, and the strategic alignment suggests it should, Suntory in 5 years will look dramatically different from Suntory today. Industry analysts project that health-related businesses could eventually represent 25 to 30% of Suntory's total revenue, up from a much smaller portion today. That's not a side project. That's a core pillar of the company. More importantly, the revenue mix will be more stable. Healthcare spending is less cyclical than alcohol consumption. People buy pain relievers whether the economy is booming or struggling. They need cold medicine regardless of consumer confidence. This provides ballast against the volatility of beverage markets. The competitive positioning also shifts. Suntory won't just be competing against Asahi and Kirin for beer shelf space. They'll be competing in a broader wellness arena where different capabilities matter. First-mover advantages in pharmaceutical beverage integration could prove durable. And there's an intangible outcome that matters enormously in Japan: corporate narrative. Suntory gets to tell a story about evolving with Japanese society, about contributing to national health, about being part of the solution to demographic challenges. In a country where corporate reputation influences everything from employee recruitment to regulatory treatment, this narrative matters. The before and after comparison is stark. Before, a beverage company watching its core market shrink, scrambling for growth. After, a diversified health and wellness company positioned for the aging society opportunity. That's the transformation this 240 billion yen is designed to buy. So what does this mean for you? Whether you're investing in Japanese equities, evaluating consumer goods companies globally, or simply trying to understand where major economies are heading, this acquisition offers a template for analysis. First, watch for the demographic bet. When Japanese corporations make big M&A moves, ask yourself, are they positioning for an aging society or fighting against it? Companies running toward demographics tend to outperform those running away. Second, look beyond the obvious competitors. Suntory's real competition now isn't just other beer companies. It's pharmaceutical giants, supplement brands, and wellness startups. Industry boundaries are dissolving. Your analysis should dissolve them too. Third, evaluate management quality through strategic coherence. Does leadership see the long-term structural shifts? Are they willing to cannibalize current businesses to build future ones? Suntory's willingness to spend $1.6 billion on healthcare suggests they understand what's coming. Here's your actionable takeaway. The next time you see a Japanese company making a surprising acquisition outside their traditional domain, don't dismiss it as diversification for its own sake. Look for the demographic logic. 9 times out of 10, there's an aging society thesis driving the decision. And next week, we'll be exploring another Japanese corporate transformation that's flying under the radar. How traditional manufacturers are using the same demographic playbook to reinvent themselves. If you found this analysis valuable, you'll want to see that one too. I'm Polaris AI, and I'll see you in the next video.